We have an email from Ed asking about REITs. Your best opinion, or your opinion on the best value here, American Tower, Crown Castle, or SBA Communications?
Sure. So this is a group that we've talked about a few times before. These are the REITs that own cell towers in the U.S. So the reason, of course, you want to own these is because, in effect, they have multiple tenants. The wireless companies put gear up on these towers. The average tower has 3 or 4 tenants. You can put more and more gear on them, so there's lots of room to grow revenues. And of course, we're going through a boom in the use of bandwidth and certainly wireless spectrum. So these companies all are in this area. I prefer American Tower. We've owned it over a long period of time. American Tower is the most international of the group. So about 60% of its revenue comes from the US, 40% comes internationally. They generate a lot of free cash flow, and it's highly predictable, like 5-year contracts. As we move to 5G, there's going to be a whole bunch more gear gets loaded up on these towers, which allows them to charge more rent. It doesn't take much to upkeep a metal tower. But, you know, American Tower has been remarkable. They don't pay a big dividend, but it's grown 34% a year over the last 5 years. So if you want to own an income-generating asset that's likely to do well in the event that we see rising rates going forward, which I think is very reasonable to expect, then this would certainly be strong in offsetting rising rates. And I don't think there's going to be a stop based on what I see with my kids in the use of bandwidth anytime soon.
Okay, yep, we're all watching those cat videos, that's right. Joel in Montreal, go ahead, please.
Yeah, David, I'd like to ask you about Costco. Like, how do you think this Amazon purchase of Whole Foods is going to affect them, and do you think it'll affect them in a big way? And you know, would you sell the stock based on this Amazon purchase of Whole Foods, or put in a tight stop on Costco right here? It's already gone down about 10% since last week on the purchase. Anyways, I'm curious if you own this as well. Okay. All right, I'll listen to your answer, David.
Okay. So let's start from the top. Certainly the retail, bricks and mortar retail in general, has been under pressure all year long. It's a group where breadth, or the percentage of stocks performing well, has been narrowing. We have chosen over time to focus on the internet retailers. Amazon, of course, is one of our big holdings, among other things. However, we do have a piece of Costco, a small holding. It has a pretty defendable position in the big box club stores, and so we do have a piece. Now, I'm not happy to see anything drop 10%. If you were to look at it, it's trading basically right on its 200-day moving average. The day that the deal was done with Whole Foods, every retailer within any shooting distance, you know, got taken out to the woodshed. I would use the 200-day moving average as a stop on this one. I think that in general, we have, for instance, in our long-short strategies, we're in a global strategy. We're long internet retailers, short bricks and mortar, and that's the way I would continue to operate. I think in the very short run, there was a knee-jerk reaction, and you will likely see some companies rise out of it, and some companies continue to falter. I think Costco is less likely to be hurt by a Whole Foods deal than some of the other big grocers.
Okay, so you'd stick with it for now?
I would keep it, and I would use the 200-day moving average as a stop loss, which is only $3-4 below where it's trading now.
Okay, so you would be poised to sell it then?
Absolutely. We run stops on everything.
Sure. Caroline in Burnaby, BC. Go ahead, Caroline.
I want to buy a tech stock for growth. Now, is this the time to buy? Is it too high? And also, should I be using my Canadian cash account to buy, or should I open a U.S. dollar account because of the foreign exchange rate? Is it going to hurt my cost? Your thoughts, please.
Okay, so let's take this one from the top. First of all, Canadian dollar. We in Canada have a slightly lower growth rate than what they're seeing in the U.S., and of course, Canadian dollar gets impacted by energy, which has been weak and is weakening. So our view has been for a long time, Canadian dollar is likely to remain weak versus the US dollar, and I would guess it's likely to weaken further from where it is currently. So I have no problem buying US dollars today with our Canadian dollars because I think we could be buying less, a year from now. So that's the first thing. I have no problem buying US security currently. Technology is probably the most important secular long-term theme in the market. Google plays right in the middle of a couple of the key themes, but the most important is cloud and search, and realistically, Google is one of the three big players there. We're going to talk about another name as a top pick today, which I would choose above Google. But we do own Google.
Okay.
And there's another large cap we're going to talk about later. Maybe has an edge. Now, technology has been leading the market. I do see signs in the near term that some of the more cyclical sectors like financials and industrials may be seeing some rotation into those names, and a little money's coming out of technology, a little bit of profit taking. But again, long-term theme technology is not going away. I have no problem owning Google, but stay tuned for the top picks.
Okay. Want to hear your answer on this one. Alex in Montreal, go ahead, please.
Yes, thanks for taking my call.
Pleasure.
David, I would like your opinion on Chorus Entertainment. Is it a buy, and is the dividend safe? And Andrew, I would like the street consensus, please.
Okay,
I'll listen and hang up.
I don't think I can do consensus today. I can't provide the consensus, but carry on, Chorus Entertainment.
So Chorus Entertainment, Chorus Media Company with all kinds of different properties. The media group in general has been doing well recently, although Chorus is lagging. So to put it in context, Chorus's share price over the last year has performed worse than over 50% of the stocks in the market. So we're in a pretty good market here, and there's some sectors that are really performing well, and I think that I wouldn't be so focused here. If you really wanted to be in something media related, I would look at something like a Comcast or a Shaw Communications. Shaw has this new X1 network that will allow them to get a lot of growth. I think that that's quite interesting. But this Chorus has been sort of dead money over the last number of months, and so I would be less interested there. I think there's maybe other things to do.
And of course, one of the interesting things about Chorus is the massive yield the stock has gone to. Let me just check.
So they're effectively paying out all of their earnings, 100%. I don't love buying a company that's paying out all of its earnings either.
Okay, and I'm told it has 3 buys and 5 holds and 1 sell, and so obviously the street pretty cautious. Yeah, the yield just under 9% on Chorus.
Yeah.
Thanks for that great question.
Just remember, we're buying total return, right? So you want the dividend, but are you going to make money on the capital value? And if the capital value is underperforming, it nets out.
Yeah. Okay. Past picks are coming at you. A couple of big winners. One tech name up more than 50%. You're watching Market Call on BNN.